19 things you are not aware of in financial technologies. The world of cash flow has transformed due to FinTech. The majority of us utilize this technology but are not familiar with the term. So what exactly is FinTech? What is the history of FinTech? Has the recent explosion in banking technology been a sudden development, or have we been moving toward this point more gradually? We can better predict where FinTech will go in the future by understanding its history. We provide you with some previously unknown FinTech history and information. FinTech, in its simplest form, is just technology used to enhance the delivery of financial services. Although we now associate the term FinTech with cryptocurrencies and startup banks, its origins may be found in the late 19th century, when telegrams and Morse code were used to transfer money. The phrase only became popular in the 21st century, but it has influenced how people handle money for well over a century. Let's explore each fact one by one. Number 1. FinTechs are not independent of banks. Banks are necessary for FinTech to provide the services they do. You may have heard claims that FinTech companies are there to drive out banks. Perhaps in the future it'll start to happen. FinTechs, however, are not yet ready to take the position of banks. FinTechs do not provide bank accounts or store money. They create virtual bank accounts with which they process payments and rely on their partner banks to store the funds. 2. FinTech is regulated by the central bank. Just like banks, FinTech businesses are subject to central banking supervision. Since they deal with money, they are governed by the same organization that oversees all financial institutions in the nation. The central bank has granted them an operating license, and the central bank has the authority to suspend or cancel their license. Double-crossing the central bank is the absolute last thing a FinTech startup wants to do. 3. Digital currency is the baby of FinTech. To put it another way, digital currency is FinTech. It is a FinTech product and is largely untouchable by the all-powerful central bank. However, several nations are starting to take action to change this. The case that FinTech will eventually replace banks is well supported by the concept of digital currency, and given the emergence of new digital currencies, that may very well be the case. 4. FinTech is a job with bright prospects. A FinTech is a place with excellent employment opportunities. Whether you're in Africa, Asia, or the US, FinTech job roles that demand a more technical skill set may pay between $80,000 and $180,000 annually. The salary range for those in non-technical roles is between $90,000 and $120,000 annually. 5. By 2022, the FinTech sector is estimated to be worth $310 billion. The industry received $128 million in investments from throughout the world in 2018. The industry's compound annual growth rate, or CAGR, is expected to be 25%, according to experts. So, by 2022, $310 billion is anticipated to be invested in the industry. More than half of the $254 billion in yearly venture capital financing went to FinTech companies in 2018. 6. There are 79 unicorn FinTech firms throughout the world as of January 2021. A privately held business with a market value of $1 billion or more is referred to as a unicorn company. While hectares are worth over $100 billion, decacorns are worth over $10 billion. There were more than 500 unicorn companies with a combined worth of $1,780 billion by the beginning of 2021. Data shows that in January 2021, 6 new FinTech startups attained this renowned rank. 7. By 2022, artificial intelligence will have saved the insurance sector $1.3 billion. Many debates have been sparked by FinTech's potential for disruption. In this, artificial intelligence is crucial. In the insurance sector, computers can automate post-accident data collection, examine photographs of the accident scenes, and carry out a variety of other tasks, enabling insurers to process claims more quickly and for less money. By 2021, $1.3 billion in savings are anticipated. 8. More and more people are moving toward FinTech. 2 out of every 7 people on the planet now use FinTech innovations in some way. The race is on to provide FinTech services to the final 5 individuals. 90% of people in China's urban and rural areas already use FinTech instead of banks. 9. When it comes to the tech in FinTech, think broadly. When hearing the term FinTech, many people immediately picture cryptocurrencies or even chatbots or AI-powered robo-advisors. FinTech is, however, much more than that. With the use of APIs, established and emerging providers of financial services can collaborate to provide customers with new goods and services. Modern AI chatbots, for example, use sophisticated natural language processing to more closely approximate human interactions. They're a vast improvement over the initial awkward attempts and can now genuinely improve the client experience. 10. In FinTech, AI is your mentor. Comprehensive client profiles are made possible by AI-powered data collection and analysis, which enhances credit and risk analysis and reduces revenue loss. Due to the data barriers that currently exist between and within business divisions of the financial services industry, decision-making processes have been notoriously difficult to automate. AI is now starting to help streamline these processes. 11. Security is a major issue to address. Security and fraud prevention are some of the service providers' top worries when it comes to payments. FinTech has an issue to solve because of the high level of fraud in the financial industry. The most crucial figure for FinTech as it relates to wireless transfers is that 62% of businesses were the victims of payment fraud in 2014, of which 27% were tied to wire transfers. 12. Asia is ahead of other regions in many aspects of FinTech. Since 2018, China has become the top FinTech investor globally. In 2018, China invested $25.5 billion in FinTech, a 900% increase year over year, and more than half of all FinTech investments globally. The market value of China's FinTech industry was $59.2 billion in 2022. It's expected to grow to $85.7 billion. 13. Digital currencies backed by central banks could become a reality. The survey demonstrates that different nations have different opinions about the central bank's digital currencies. A little over 20% of respondents claimed they are considering introducing such currencies. Even so, there were only 4 recorded pilots, so the effort is still in its early stages. Lowering costs, improving the effectiveness of monetary policy implementation, fending off competition from cryptocurrencies, ensuring the competitiveness of the payment market, and providing the general public with a risk-free payment instrument are the primary arguments in favor of the issuance of digital currencies. 14. FinTech has helped those in extreme poverty. FinTech has helped millions of people escape the depths of extreme poverty by providing them with access to financial services they would not otherwise have had. A banking app can save you valuable time and money when it comes to managing your important financial concerns in the Western world alone. That is sufficient for regions where there is typically a selection of banks in each town center. But what if you reside in a primarily rural nation where traveling to the nearest bank could take several days and be dangerous? The growth of neobanks has significantly reduced the unbanked population in places like India and Kenya, indeed, in several African countries. 15. FinTech is a solution to the billing problem. Some of the most well-known and talked about FinTech apps address issues that can only be referred to as first-world problems. Even though it doesn't take great mathematical prowess to divide a bill fairly and ensure that everyone pays their fair share, several companies are competing in this industry, including Splitwise, SettleUp, Tab, Square Cash, and others. Yes, you can fix an issue with a calculator and the option to choose pals who aren't freeloaders, but there are at least 4 apps available on the market to do so, and that's before factors like Patreon and Kickstarter are considered. 16. FinTech startups are hot and international. The fact that investments in FinTech increased last year is hardly surprising. To show the wide range of solutions and innovative players in the global marketplace, we have covered the 22 hottest FinTech firms from Silicon Valley and the 14 hottest FinTech startups from India. The payments industry garnered more than $1.16 billion in investments in the first quarter of 2015. 12 startups raised more than $5.6 million in early funding rounds, with BringHub raising the most with $2 million. Moreover, $750 million was invested in FinTech within the brief period of July to September 2015. 17. New types of stakeholders are entering the space. FinTech firms were thought to be more interesting to banks and other traditional financial institutions since they were disruptive and competitive. This isn't the case right now, though. Tech companies that dominated other industries began to compete for financial innovation. It's astonishing to see how actively committed the software giant Microsoft is to FinTech with so many different initiatives. With their active investments, Google, Intel, and others have also shown that they're interested in FinTech. 18. New types of partnerships. The power of integrating financial transaction elements into their massive social networks has been recognized by social media and communication powerhouses like Facebook or WeChat. WeChat, China's largest messaging app with over 600 million active users, announced a deal that allows WeChat users in the US to send money to 200 countries and territories using Western Union's Connect platform. Facebook, which was designed to be a social media platform to connect millions, recognized a wonderful chance in adding a valuable feature to money transactions. One of the most well-known peer-to-peer payment apps, Venmo, processed more than 900 million transactions in the fourth quarter of 2014. 19. FinTech 2.0 is coming, and fintechs and banks are collaborating. According to the paper, while some fintechs are currently focused on the race to build self-contained startups, FinTech 2.0 represents a much broader opportunity to re-engineer the infrastructure and processes of the global financial services industry, in which the top 300 banks command a revenue pool worth $3.8 trillion. Both banks and fintechs have strengths and flaws, and both are better suited to working together and utilizing their finest assets to address each other's shortcomings. Banks and fintechs must work together to take advantage of FinTech 2.0's potential, with each party contributing what the other lacks in terms of data, brand, distribution, or technological and regulatory experience. This ends the video for today. Tell us in the comments if you have any interesting facts to share. Like, share, and subscribe to the channel to find out more.